Hey Matt, how's it going? It's our next week's episode of Going Live with Good Soil. You were sick this past week, right? You feeling better?
Yeah, we had COVID go through our family finally, so I've been a little sick, but more so just kind of exhausted from dealing with the kids and being up in the night with them and handling all the little, crying and everything going on during the day. So yeah, I've been at diminished capacity for the last week or so, but we're on the up and up now and starting to feel better.
Okay, good, good. I'm glad. I mean, I think I saw some like estimate on Twitter that like somewhere between like 5 and 10% of the whole U.S. population currently at the moment has COVID or something. It's kind of crazy that
Yeah,
you know.
it does seem crazy. Like, like since this started 2 years ago, we've always kind of known one person here or there that has it. But
Mhm.
just in the last month, it seems like everybody I know has COVID.
Yeah.
I mean, just as an anecdote, there's like a group of friends who my wife and I get together with like once a month, and 7 of the 8 people in that group have had COVID in the last 3 weeks, and we haven't even seen each other yet. So it's not like we got it from each other. But
Yeah.
it's just, at least in my community here in Michigan, it's like ripping through, and like I know
Yeah.
way more people that have it right now than
Yeah.
was certainly the average in the last year or so.
Yeah. So just so everyone's aware, if this is your first time on here, Matt and I are doing our weekly live stream on our Good Soil Investment YouTube channel, and we also do it at the same time on Twitter Spaces. So this is being recorded, and it's approximately an hour. We talk macro markets, obviously our favorite stock, Tesla, and some other stocks, and take a lot of Q&A at the end. And so, yeah, we'll just get it started here. And just to kick things off, Matt, what was fascinating as I was preparing for this, I don't know if anyone who's using Twitter Spaces right now, there's actually another Twitter Spaces going on right now that's entitled, "Is Tesla the next Theranos?"
So
Yeah, and
what's your response? Is it?
I went on it for 15 minutes before, like from 9 to 9:15, because then we had to prepare for this. And I was on it and I got requested as a speaker and they accepted me. But there's like one guy sort of dominating the talk and, using kind of intimidating, like every other word's like a curse word, but he's totally bad mouthing Tesla. It's just like, I think I told you it's like Montana skeptic with much more abrasive language use. So, and talks over people and such. But there was like, a 2 or 3 defenders of Tesla that were being very polite, but they're kind of being talked over. And then there's like 3 or 4 people that are speaking that also are trashing Tesla, but they don't seem to be very convicted in their trashing of Tesla versus just like one guy sort of dominating the conversation. It was interesting. There's 200 and something people listening. I'd love hearing the bear case. I love hearing, as much as it triggers me sort of emotionally because I'm so like invested, like I'm aware of that, how like my natural knee jerk reaction is to be like upset and be like, who is this guy? Why is he saying all this bad stuff? But then I have to think, I use my brain and I realize, I need to learn what their case is. I need to try to be empathetic with why some people still think Tesla is a fraud, and understand where they're coming from because, you know, number one, I want us to try to find holes in our hypothesis of Tesla always,
Mhm.
I've always been doing that. But number two, it's actually good to know when everything they say, when you feel like it's not something you haven't heard before and it's easily like misinformation they're kind of quoting. Um, like this guy was saying, there's like 2 or 3 autopilot deaths a weekend and Tesla hides it. It's crazy.
What?
And yeah, I don't know. It's nuts. He's like, in China, it's killing people every other day there. No one even they don't talk about it. I don't know. He was just like, you know, but when I hear that, it kind of helps me realize that there's still so many people, and I hear there's several other people on this channel that sort of agree with him that there's still so many minds to be won over.
Mhm.
It's not an overcrowded investment by any means yet. Sometimes I feel like it is, given our tunnel that we're in of Tesla bulls, but in reality, in the big mass population, it's certainly, I don't think, overcrowded yet.
So I think there's I think there's a bridge to making a like a decent bear cases, but then you've got to cross that bridge to go all the way to fraud. So was there anything?
Yeah.
Presumably, there's nothing that seemed like a credible kind of fraud data point to you. But was there
Yeah.
any kind of decent bear case that was put out there that you hadn't heard before, or that seemed to have a nugget of truth in it?
No, nothing I could see. I mean, the guy was basically, I mean, the perspective he had is that the full self-driving is being overcharged and it's just it's a scam. And someone could make that argument if they don't believe in the technology. If they think it's never going to succeed, and they think Elon, you know, they can try to make the case that it's a intentional scam, that Elon's just trying to collect extra money off the top. You know, I mean, that's a really far-fetched, you know, idea, but you can make that case, I guess. So that was like a big part of the discussion. And yeah, I mean, it's just that no one else can, you know, that the other car makers, self-driving car makers, are way better than Tesla and are safer and all this stuff. And then they'd be present, you know, someone would, you know, someone who's like a Tesla supporter would join in and say, well, you know, statistically, they only have one crash for every 10 of other cars, and they would just be totally ignored. And then they'd keep going on to why Tesla's unsafe and stuff. And Elon's covering up all the regulators and fighting tooth and nail to keep them quiet, kind of thing. You know, that was kind of the case being made. Yeah.
Yeah, interesting. You know, it seems a little bit like the opposite, given you know, that appointment to NHTSA. I can't remember that woman's name who was
Missy
just appointed.
Cummings.
Missy
Yep.
Cummings, that's right. Yeah.
Yeah.
You know, it seems very clear that there's, you know, a huge amount of scrutiny. It's not this like, how would Elon even be covering that up, or like,
Yeah.
it doesn't really make any sense to
Yeah.
I don't know.
Yeah, no, it was fun. I wish I could have stayed on it longer, but you know, if there's other folks on this, you know, Twitter Spaces that want to listen to it, jump over to it. Ours is being recorded, can be watched later if you want to catch it later. But it's healthy for anyone who's a Tesla bull to at least be able to tolerate listening to the bear case, right? I think it's very important. So whatever it is in my personal belief system, whatever I believe in strongly, I have to also be ready to tolerate listening to the other side. That's kind of my own personal approach philosophically. Otherwise, whatever I'm believing in, you know, how can I know that it can withstand the test of time and truth or whatever? You know, I have to be able to listen to both sides and tolerate it at least. So
yeah, I mean, you're trying to find the truth. You're not trying to reinforce your prior convictions. That's
exactly,
a
exactly.
recipe for disaster as an investor, to just trying to, you
Yeah,
know, reinforce your original view rather than take in new data points and adjust.
yeah, yeah. So with that side note kind of out of the way, you know, again, if anyone's late, there's a Twitter Spaces going on right now called "Is Tesla the Next Theranos?" And there's like 200 and something people on it. And I was on it for, you know, 15 or 20 minutes before this live stream, listening to some of the crazy stuff being talked about on there. So people can go over and listen to it if they want. It's encouraged. Anyway, so for moving on to our normal mode of operations here. So first, the macro market, you know, like it seems to be the story every week for the last several weeks, right? Where we have this huge kind of dump of growth stocks. Kathy Wood's ARK Investment Flagship Fund, which is, you know, which we use as sort of like index for our investing bucket of stocks, is going to lower and lower lows every week and sell-offs. And Kathy Wood had a really good macro market kind of discussion episode on Friday, In the Know with Kathy or whatever it's called. I listened to that, and I love her macroeconomic outlook. You know, I find her to be ring true what she says more than any other macroeconomist. Although it's sort of a fine line when she says the market is irrational or being irrational. You know, I mean, that's sort of the headline quotes that have been going. She said exactly that. It might have been taken out of context, but you know, I'm a strong believer in not saying the market is ever wrong. You know, the market is always right by definition in my mind, and we just have to adapt to it as best we can. So, I don't know. Did you listen to her discussion, Matt? Do you have any thoughts about that? Or
No, I didn't hear her thing on Friday. I've heard a lot of her commentary in the past, though.
okay,
And one of the things, you know, I'm curious to know if she touched on this. She talks a lot about technology being a force for deflationary pressure, which she thinks will kind of overcome, you know,
yep,
any of these inflationary concerns. Was that another one of her
yeah,
kind of viewpoints? So
that's still one of the
I have a
viewpoints. Yeah,
little bit of I don't want to say a bone to pick with that, but I think it's true in many instances. So like Tesla will be like has a deflationary battery curve, for example. So once they can scale up large enough, you know, they've done a lot of work on Wright's law and showing how they can really reduce the costs over time. And I certainly believe that over time, you know, EV costs will come down. But I don't think that's necessarily true for all segments of the economy, you know, energy in particular, and like, you know, food. things that aren't really, subject to, disruption, I think we'll see inflationary pressure. So I haven't heard her distinguish between those different types of or segments of the economy. Is that something that she touched on at all? And if not, maybe what's your thought?
A little bit. I think that's more of like a medium to long term. And she, she
Hmm.
touched on it, and I think she just thinks everything, there's sort of like a lot of value traps going on, and
Sure.
the, growth tech stocks are into kind of, she referenced Zoom and their revenue growth, like, how they had like 86 or some ridiculous growth last year. Then this quarter, it's 20% year over year, but it's supposed to accelerate again. So Zoom is an example of a stock that's been hit too hard that, she strongly believes in, that's going to pick back. It's already entering like value stock territory, but it's actually growing like a growth stock. So, there's just some weird anomalies that she thinks is going on, I think. And it's true. Maybe from her perspective, there is. And the question is, how long can that kind of anomaly go on, before the market kind of overcorrected, right? I mean, I think it's human nature for the macro market, especially, to just kind of overcorrect itself. At some point, we're in kind of overcorrection territory of this kind of new rate environment
Hmm.
of adjusting growth stocks. Have we gone into the overcorrection territory already, or are we not quite there yet? I mean, that's, I guess, the big question. And she clearly thinks it's way overcorrected.
Hmm.
But I think we were overcorrected to the upside previously before this kind of re-rate environment, it seems. But yeah.
Yeah, I was listening to Jerome Powell had his reconfirmation hearing this morning. I was listening to a little bit of that. Did you catch any of his comments on that before
I
we
did.
jumped on?
Yeah, I was trying to
Yeah,
catch up to that too. Yeah.
I think he certainly the market seemed to like what he was saying. At least initially, I think some of the gains from that have been given back in the last half hour or so. But
Yeah.
I think he did a good job of kind of calming the markets and saying, there's going to be a long road to normal, in terms of getting back to like a normal monetary policy. He was talking about being in this low interest rate environment for a long time, and kind of the transition to rate hikes and kind of more normal interest rates. I think he was painting a picture broadly with several of his comments that seemed to indicate that this was going to take a while to kind of revert back, and he even questioned shrinking the balance sheet, and if so, it sounded like later this year rather than earlier, as a lot of people had thought. So
Yeah.
that certainly seems to create some more wind in the sails of growth stocks. That it's not going to be the rug's not going to get pulled out from underneath them in terms of kind of an abrupt change in monetary policy. So I think that's good news for a lot of
Hmm.
the companies that we play with, or
Yeah. Yeah. I think it's almost like he didn't give out more bad news that's already been
right.
priced in, and I think the market like that, because every week it feels like there's a little more incremental bad news of rates going up faster than, anticipated every week or every other week. And that's been causing the market to kind of edge lower and lower. And this is the first like data point from the Fed where it doesn't seem like there's more bad news. It's already kind of the most of it is already out there. And in terms of how fast they're going to rate, make interest rates go up and de-risk the balance sheet and such. And I think that we're in kind of that weird territory. Every once in a while, in like the macroeconomic cycle, we kind of get into this backwards territory where like it feels like the bad news for the macro market is good news for the stock market. It's like,
Right.
yeah,
Right.
oh, jobs are even worse. Oh, stocks going up. That means rates will stay lower, or whatever it is. It's like it's kind of a weird in the macroeconomic cycle when we get to these points where it's like people are almost like rooting for bad news economic indicators so that it prevents the Fed from raising rates faster or something. And I'm always suspicious when we, just something doesn't feel right about that every time, every few years we get into kind of this mode, and it just kind of seems strange to me or odd. It doesn't seem to fit, but that's just the way it operates, I guess. Right. I mean, what do you think about
Yeah,
that?
I think you certainly see this with the jobs report. I think, what was it, Friday? They were expecting something like 400,000 new jobs, and it was like half that.
Hmm.
And so people are like, okay, that's bad news, which is good for stocks. And
Yeah.
so it's
Yeah.
like,
Yeah.
because it puts pressure on the Fed to kind of keep the
Keep
easy
rates
money
lower.
spigot
Yeah.
going. And so in the short term, I certainly get that, but it's one of those things that you have to pay attention to, because in the medium term and certainly in the long term, like you've got to pay attention to like the fundamentals of the economy. If GDP is not growing because there aren't workers, you can't have like a rip-roaring stock market that's going to be going up 10% a year, at least for an extended period of time, because you need the underlying economic strength to kind of bolster the sort of equity returns that you're going to see, earnings power of the companies. So that is something that I'm concerned on in the medium term. I do think even if that reality does pan out, though, I think there's going to be a wide disparity between the winners and losers in that situation. So I still like the group of companies that we're invested in, because I think they will be able to weather a severe economic downturn better than most of the others. But it certainly warrants keeping an eye on it, and it could definitely impact the stock market and valuations going forward.
Yeah. Where I guess the next thing is Tesla, right? Where does Tesla shake out in all of this? I mean, what's the what do you think the worst case, best case scenarios for Tesla with the macro market environment?
It's hard. I kind of view Tesla as one of these in-between companies. So
yes, me too.
Yeah, like
in between value and growth, right? It's like sort of growth for sure, but it's almost a value stock already too, right? It's kind of like the best of both worlds almost.
It really is. So just for people who maybe haven't seen some of our previous videos where we talk about this, when you have interest rates rising, it increases your equity discount rate, which reduces the so you need to use a higher discount rate to present value the cash flows of a company. So that hurts growth stocks more so than like value stocks or highly cash flow positive companies like Apple. So Tesla certainly is kind of a growth stock because they're growing at such a rapid clip, but at the same time, they're generating several $1 billion of operating cash flow per quarter, and they have kind of turned into this surprise juggernaut of cash flow. So they have this situation where their fundamentals can serve as a little bit of a backstop, so that even if macro deteriorates and let's say treasuries go up, it certainly will be bad news for the Tesla stock if that happens. But I think you can still use relatively near-term valuation metrics as something of a backstop of the current share price. So I think it'd be very difficult to see, even if interest rates really rose more than we're expecting. I could see some really growth companies, like Lemonade or some of the others that are really like true growth companies that are not cash flow positive. Those could get really pummeled, and it's not outside the realm of possibility that they could get cut in half. But Tesla, the reaction couldn't be as severe just because you've got forward price earnings multiples or EV to EBITDA multiples, or even just like a discounted cash flow. Sure, you can use a higher discount rate, but it won't result in like cutting the valuation in half. So I think they're going to be relatively safe in this environment. Not to say that there's no downside, but I think it's less downside than some other names.
Yeah, and just to elaborate on what you said about the discounting cash flow method, just to almost like a more first principles point of view of an investment of a stock that I think of frequently is the true theoretical current price of a stock should really theoretically be the future value of all the dividends it ever pays out, discounted back to present day value. So, sure, there'll be great cash flow, but you have to also imagine, okay, Tesla could get to a place where it actually is paying huge dividends in the future one day. And you have to add that up and discount that back to present day. So when interest rates go up, obviously you're discounting all that future dividend, payout at a different rate. And that's why the stock price would be lower, obviously, too. So it's sort of in line with what you said. But just to take it a little step further, instead of just measuring the cash flow in the future, I think theoretically it's like, Apple's now paying a dividend, for example, right? And so like Tesla at some point, I would imagine, will pay a dividend down the road one day, whether it's 3 years, 5 years, or 10 years. At some point, it will grow and generate so much cash they can't spend in an efficient way. I would believe they'll give some kind of dividend back to the investors. So we'll see how that plays out. But that's sort of what I keep in mind when I think about, could Tesla be paying one day pay a $200 billion a year dividend or $500 billion a year dividend? I think, yes, one day in the future it could pay that much in dividends, and so I still think it's still a steal at these levels historically when we look back in 10 years. Anyway, it's exciting. Tesla becoming the stock of all time, in our opinion, or my opinion for sure. I think both of us believe that.
Yep.
And, we'll see how the story plays out over time. I also think the gross margins is going to improve and couldn't come at a better time for the worst case scenario that we're talking about, because higher gross margin signals higher cash flow in the future as well, which I think helps the discounted to present day value at higher interest rates and such. So I do think Tesla does have a nice backstop versus other growth tech stocks. Yeah, it could get cut by like 20, 30, 40, even 50% temporarily, who knows, but it's not getting cut by 80%. All the other growth stocks could worst case get cut by 80% from here still, in my mind. If they're not generating cash,
Right.
it could go, the floor is the limit, is how low they can go, if interest rates are coming up faster than everyone expects, and so I think Tesla is a little bit safer because of the gross margins improving and cash flow actually generating versus, 2 years ago, they weren't really generating cash or gross margins, positively too much. So, yeah, I mean, are you worried about our other stocks that we talk about, Rocket Lab, Lemonade, or Roblox, Matt? Are you?
Yeah, I mean, I think you've seen all of them have pretty steep hits in the last, I don't know, month or so. So it probably would have been better to be more worried about them, back in December than right now. But I think we've talked about this before. I mean, we highlighted this actually as a risk like several months ago, that those companies in an environment like we're seeing right now would be more impacted than Tesla, which is exactly what we were just saying, and it's exactly what we've seen happen. So sure, I do remain, I don't want to say worried about them, but I think they are more at risk than Tesla. But they're also trading at pretty steep discounts relative to what Tesla is offering. So you can also see more opportunity for upside as well. Particularly, I think with Lemonade, which is
I was just
basically trading at its all-time lows right now.
I'm excited about Lemonade. I mean, I'm looking right now, and it's a very shorted stock. Like on the Interactive Brokers platform, it's even though there's a very low borrow fee of like just 1%, there's only 114,000 shares available to borrow, which is kind of low. But also on the Interactive Brokers platform, it says there's an 87% utilization rate. And what that means is if you're long Lemonade stock and it's fully paid for, you're not borrowing cash on margin, but you're long Lemonade stock, and you participate in the Interactive Brokers automated stock lending program, which I love, personally, and do participate in. It's like free money for your personal trading account, very minimal risk if you look into it, in my opinion, not investment advice. Just by the way, none of this is investment advice, what we're talking about. This is all our own opinions. But the 87% utilization rate means that 87% of your fully paid for Lemonade shares are getting lent out, which is very high. ARKK is 100% right now, which is crazy. Some people must be shorting ARK as a hedge, which I haven't seen it that high. Matterport is 100%. Lucid is 100%. Wow, Lucid has a 107% borrow fee right now, 0 shares. There must be a short squeeze going on with that, why it's up right now. But most stocks don't have very high borrow fees, like nothing above, utilization rates, I mean, of the shares being lent out. But 87% is pretty high. Once it's above like 50%, that's pretty significant in my mind. And so to me, it signals there's a lot of shorts that need to buy in, and people have been buy back their shares.
That's exactly what I was going to say. I mean, if you opened a short position on Lemonade a year ago, then the stock's down 79% since then. So that's
how much more upside are you going to get?
Exactly. You're not going to risk a huge amount of upside from here to like squeeze out an extra 10-15%. Like the maximum you can get is 100% if they go bankrupt. So if you got 79% right now, like call it a day, that's a home run for a short. So there has to be some level of short covering in the medium term for Lemonade in particular, I think. Just because you're approaching these kind of theoretical limits of the return on these. So you don't want to play chicken when you're a short, and but then once that covering happens, then that's going to obviously have a positive impact on the stock price, and so
Yeah.
it will potentially cause a short squeeze where people want to lock in their profits, and so it wouldn't surprise me if Lemonade has a relatively sharp movement in the short term. Not saying that it will, and again, not investment advice.
I could
but
see
to
a
me,
double in like a short period of time, whether it's 1 month or 2 months or 3 months. I could see a double. But I could also see it going lower, but at some point I could see it doubling pretty quickly. I mean, it's 2.4 billion market cap right now, and it's got like 1.2 billion of cash or something on hand. So, like, is it going to get more than cut in half? Like, can it trade lower than the amount of cash they have on their book? I don't know. It seems hard to believe. I remember years ago when I was at Interactive Brokers, and it was after the 2008, crash. Interactive Brokers briefly traded around the amount of cash on their balance sheet, and lots of people were just buying up the shares. Like, I'm buying tons of Interactive Brokers at like $12 a share or whatever it was then, because it was like the equivalent to the amount of cash they had on their balance sheet. And so it turned out to be a foolproof trade. It couldn't get much lower than that. So, I don't know. I guess you have to really believe Lemonade's just bleeding cash, and it's a business that's just dead in the water. If you think it's going to go even below the cash value, it's just it's going to be crazy to see that story play out over time. I'm pumped. In my personal IRA account, I was able to free up some cash to buy some yesterday actually, or 2 days ago. Nice. So at 35 and 36, I talked to some people who had some interesting data points about the amount of employees per customers. For example, like Lemonade has I think it was I forget, like one employee for every 1,200 customers or something like that, and other insurance providers like one employee for every 150 customers. I forget what the exact data point now, but I'll go back to it later. But there's just a lot of really good data points to me about Lemonade's fundamental story still in play. So yeah, we'll see what happens with Lemonade. Yeah, we've been talking about it a lot, though.
Yeah. And we'll just so everyone knows, we're going to be doing a deep dive on Lemonade with one of our interviews coming up. So in the next week or so, you'll see us go into this in more detail.
Yeah, definitely. I'm trying to get. There's a guy who's got put a short to Muddy Waters is the name of the fund, and they've had some famous short positions on things like Lucky Coffee in China and some others. And I think they were short Tesla at one point. Yeah, Luckin Coffee. I think they were short Tesla at one point, but they reversed it, and went public about reversed or just giving up on their short, which is, it's respectful. If a short goes public, saying like, hey, we're not going short anymore, and it was wrong. I think that's okay. But they wrote a short report about Lemonade, earlier in 2021. And so I wanted to see if we can get them on our show to interview them about the short thesis for Lemonade. I think that'd be really interesting. So we'll say it's Carson Block of Muddy Waters. He's the guy who runs that shop, and they're pretty well known in the hedge fund short community. So we'll see if we can capture his attention maybe. So yeah, we'd love to explore both sides. Roblox, also, we're excited to see what their fourth quarter financials are going to be, with the bookings in December. I've heard lots of anecdotal stories now from lots of people saying, yeah, my nephew or my kid has gotten Roblox gift cards, or my kid got an Apple gift card, used it to buy Robux, all this stuff.
Yeah.
I just feel like there's a lot of bookings in December that maybe the market's not ready to, hasn't been ready to digest yet. And maybe it could be a nice pop for Roblox when that comes out. So I'm excited to see how Roblox plays out. And Rocket Lab is a longer term play, like we talk about. We're excited about its technology, but it could be years before it's really the space industry ticks up again, where Rocket Lab really comes up in value.
Yeah, and just as a reminder for anyone who is holding those warrants, the ratio, I forget what it's called, the conversion ratio was finally locked in. I think it was just yesterday the final calculation went out. So you want to make sure you either sell those warrants now, or otherwise advise your broker to convert those warrants into shares. So just a heads up for anyone out there who is holding those warrants. You got about a week. I think it's the 22nd. Those or maybe the 21st, something like that. In the next couple of weeks, those warrants will be converted, but you need to take action to avoid the kind of the cash conversion
Yeah, and again, this is just our thoughts about it. We're not telling people or advising people what to do, but just something to be aware of with the warrants. Definitely look into it yourself and make a decision on your own. But we're just advising kind of what we thought of with ourselves and have decided on with the warrants, our position. So. Yeah, I guess we should just move on to Q&A for the last half hour. There's a lot of questions, a lot of people listening on Twitter Spaces and on YouTube Live. And maybe, Alec, you want to just kick off some questions? We'll just get through as many as we can in the next half hour. At 10:30, it's like back to back. At 10:30, it was like a great Twitter Spaces going on with the Tesla's at Theranos, next Theranos, which I caught a little bit of, then ours. And then next at 10:30 is Kathy Woods going live on ARK Invest's monthly webinar. So I'm going to try to get into that too right after we're done to see what her latest update is. So anyway, let's get to marathon. It's a good day. Tuesday morning is a good day. All right. From Life at 130 beats per minute on Twitter, what is your theory on why Tesla increased full self-driving from 10,000 to 12,000? I think they're closer to level 4 than, Elon's at the forefront. He makes these decisions. Elon makes the decisions, and he's at the forefront of the latest technology and understands. I listened to the Lex Friedman interview. He seems very confident. It was a much harder problem than he even suspected, but he's still very confident they're solving this. And I think they're much closer to level 4 than people realize. And this is kind of like a precursor to that. So you get it at 12,000 with some more features, and then maybe in another 3 months it goes out. It's so good that he rolls it out to wide, maybe 3 months even. I don't know. I think we'll be surprised. A lot of people backed up their timelines to like, oh, it's still 2 or 3 years. But I think this year, I believe in Elon in this latest timeline he put out on Lex Friedman's interview. What do you think, Matt?
Yeah, the MBA.
You've been driving it too. Yeah, but tell us after that.
I have, but not like the last week or so. I've been kind of quarantined the last week, so I haven't seen too much of the newest version. I actually got a software update yesterday. I haven't had a chance to drive it yet, though. But James Dalma had a really great perspective on this, and when a tweet that he put out. I was saying the MBA in me likes to think of like revenue optimization, and like pricing, and kind of think of it in that framework. But James was saying, that he thinks it's more about setting price and value expectations rather than about optimizing revenue. So, he's saying, let's get people used to thinking that this is like an incredibly valuable proposition. And maybe that's actually not the right thing for optimizing revenue right now. But in 12 months time, or whenever, you get to level 4 or whatever, when you've had this history of it being at $12,000, then if they want to charge $20,000 or $25,000, it won't seem as crazy, and it wouldn't stir the pot as much as if, say, like maybe $5,000 right now, it would be like the price or the revenue maximizing price. I don't know that that's like, just for example. I think if you did that and then you tried to all of a sudden increase the price to the $25,000, people would like flip out and take rate would plummet. But I think what James is saying is that if you set the price expectation right now that, this is not done, but it's already worth $12,000, then when it is done, and it's several times better than it is right now, that it's not going to be such a hard pill to swallow to make it a, $20,000 plus option. So to me, that makes a lot of sense. And it's much more about optimizing long-term revenue than it is about kind of maximizing short-term profitability.
Yeah, no, I agree with that. There's some maximizing of short-term profitability here going on too. So, all right, next question. Luke Abella, what are the advantages with using Ebit, Ebit versus EBITDA over EBITDA versus GAAP net income when projecting Tesla bottom line? Do you put forward multiples on GAAP or non-GAAP over EBITDA for projection reliability? Thanks. Matt, do you want to digest that and take a stab at it?
Sure. So, the normal ratios that you'd look at for valuation are like, EV to enterprise value to EBITDA, or like GAAP net incomes, which is earnings, so price to earnings. Those the main differences between those are, one is EV to EBITDA is capital structure neutral. So meaning you have enterprise value, which includes debt, and you have EBITDA, which excludes interest expense. So that is kind of like a capital structure neutral way of comparing companies, whereas like a price to earnings ratio, PE, that's only on the equity side. So if you're trying to compare companies with different balance sheets, so like, Ford, for example, we were talking about last week, has something like a 60% debt to enterprise value ratio, whereas Tesla's like, I don't know what it is, like 5% or something. Tesla basically has no debt relative to its enterprise value. So EV to EBITDA multiple is probably more appropriate if you're going to be comparing companies that have drastically different balance sheets or debt levels. But I think most people on the street tend to use price to earnings ratios. And for Tesla, since they don't really have any debt to speak of, it almost makes more sense to use a PE ratio anyways, because it's like you're going to be using EV to EBITDA multiples, which if you're looking across the industry, those are generally like if you're doing comparable company analysis, those will be for the most part based on companies which have kind of different balance sheet structures. So Tesla EV to EBITDA multiple will look more like a PE ratio because they don't have so much debt. So for that reason, I think it's more helpful to look at Tesla on like a adjusted EPS basis, and that's the primary metric that I use when I'm doing like modeling. But it's still helpful to look at EBITDA, which is really just kind of a proxy for cash flow generation or operating cash flow. So hopefully that helps answer your question. But yeah, I prefer PE personally.
All right. Next question is from Martin Muldoon. Do you think Tesla insurance can be a significant contributor to Tesla's bottom line? I was listening to, I didn't get through the end of it, but yesterday Dave Lee released his interview with Pierre Ferragu, who's kind of a prominent, well-known Tesla analyst. And he mentioned that he thinks they've done some analysis on the insurance making up I forget the metric he used, but like it was a huge amount of market cap. I don't know about it though. I don't know. I mean, what do you think?
Yeah, I was listening to the same thing. He said something to the effect of it has the potential to increase the profitability per car by 50%. So
Yeah.
I forget how he worked through his math, but it was something like,
on top of the full self-driving, I think too, right? It was on top of that,
I
or
think
no?
he was saying like the full self-driving could be like a 4x increase depending on take rate and something like that. But he was saying like, yeah, if you have, I forget what his exact numbers were, but it was something like if you have $5,000 of profit per car, but then you have $200 per month of profit from the insurance, and you multiply that, or you present value that over the life of the car, then that's like a $2,500. Basically 50% of the profitability could be increased just by having insurance. I didn't run the math either, but to me that strikes me as a little bit high. I've always kind of assumed that they would run their services business line, so like thinking of superchargers and act like maintenance, like all your Tesla repair center services. All that. I think they're going to try to run that close to break even, with the idea being you want to pass on those savings to customers, and really make money on selling the car and full self-driving and some other items. But I don't think they're going to, if they're making huge amounts of money on that, then they won't be as competitive with other insurers, I think is my kind of thinking. So I'm not sure where I go, but I was a little bit skeptical of those numbers Pierre put out.
Yeah, I mean, I think it'll be, and I see Rolando Velas in the chat saying 15%. He thought he said instead of 50, which we could easily, he's got a heavy accent. We'll have to listen to it more carefully before we really make it. 15% seems more pragmatic.
That
or
seems
realistic.
much more reasonable to me. Yeah,
yeah. I agree. That's possible. That's more at a marginal side. I don't think Tesla's gonna. The insurance is that much of a boon. I think it'll be nice icing on the cake, but I don't think it's gonna dramatically change the $1 trillion market cap to like it's not gonna be hundreds, maybe I don't know. It's not going to add more than a few $100 billion at the very most market cap to the company overall in my mind, but how I get from A to Z, I don't know, Matt, I leave it to you to kind of work the number.
No, I think, the way I've thought about this though, is, you have a better user experience. It makes people less likely to switch from Tesla to another car company. It makes the total cost of ownership lower, and kind of increases loyalty, which all those things
Yeah.
convert into pushing up demand, which
Yeah.
is really
Yeah.
the ultimate goal, is kind of
Okay.
increasing EV adoption. So I think that's
Okay.
going to be the goal, to kind of optimize for, long-term sustainability of demand.
Yeah. Now, Nick Carter in the chat is saying he also heard 50%. So we'll have to listen more closely and before we kind of opine on it, I guess, next time. But yeah, Tesla insurance is we don't think it's going to be a major change to the bottom line for Tesla. It'll be a change. It'll be definitely an increase in the margins and so forth. But it's not going to be like the as big an effect as like the Tesla bot, a whole new product and total addressable market or full self-driving or whatever. So anyway, we'll go to the next question. That was a good one. We'll dive into it more later. Okay. From Mahendra Reddy, do you think at 4.9 billion Rocket Lab is a bargain? This is the question, this is the multi-billion-dollar question. I mean, I think if you think SpaceX is a bargain at $100 billion valuation, then I think Rocket Lab is a real bargain at 4.9 billion valuation. I think that's how I would answer it. If you think SpaceX should only be worth 30 billion, then maybe Rocket Lab is appropriately priced at 4.9 billion or something like that is what I would say. That's sort of how I think of it, because there's nothing to reference it with. It's like a space industry company. It's years away from becoming profitable. You have to reference it with another space industry company, right? At this time, that's the only way to really have a reference price or target valuation that you think it can get to, in my mind. And so if I'm assuming that SpaceX has somewhat of an appropriate valuation right now, then I think currently Rocket Lab is way undervalued. That's just our opinion after researching it, and we believe it's like the clear second place to SpaceX in the space industry. You have any thoughts or further comments, Matt?
Yeah, I mean, the only thing I would add is there is some execution risk with Rocket Lab. I mean, they're trading at, I forget the exact number, but it's something like 30 times revenue right now. So for $4.9 billion to be a reasonable valuation, they do have to succeed in kind of their long-term vision of drastically expanding the pie and really ultimately providing constellations services back to Earth, which will be a much larger business than just the low Earth orbit launch business. So there is execution risk in there that's real for them to kind of achieve that end goal. Because you could imagine, like, all right, let's just say they're a great LEO launch company. Well, 10 years from now, if they're just a really great LEO launch company, I don't think they're going to maintain a $4.9 billion valuation unless the LEO launch services business is just way bigger than I think it will be. So there is that real risk in there. I think they need to do a lot of execution over the next 5 years. But I think once they do that, then the upside potential from there is like 10x or more probably. So bargain, sure, but not a sure thing.
Yeah. Well, I mean, you just referenced 30 times revenues. SpaceX at 100 billion is trading at over 50 times revenues of 2021, I think. So as a reference point, that seems to be about what the space industry company, the top ones, are trading at, right now, because there's so much future growth and execution built into it, successful execution, obviously. But obviously many people are confident about SpaceX executing on Starlink into a profitable business, and that's a large part of the valuation there.
Yeah, and I'm not positive on that 30 times ratio, but it's somewhere in that neighborhood.
Somewhere there.
So don't quote me on that exactly, but it, dozens of times of revenue.
Yeah. And just as a quick side note, back on the lemonade point, I see in the chat, Kevin Yang just referenced that, for 1 million customers at the end of 2020, so a year ago, they had 567 employees. So that's 1,763 customers per employee as of the number of customers they had at the end of, or the number of employees they had at the end of 2020. So that was a year ago. So we'll see. I think that's probably been up. They've probably increased a lot of employees since then, but they've also increased customers beyond 1 million. So we'll see what that ratio is, but it's way lower than the rest of the insurance. That ratio of customers to employees is really good for Lemonade versus the rest of insurance.
Yeah. Well, imagine like an insurance broker having 1,763 clients.
Yeah,
that gives you an idea of like the scale of their efficiency. The a potential for their efficiency if they can really scale. I mean, you could just imagine that operating leverage, you know, if you can maintain that sort of ratio while growing your customer base, like, oh gosh, it could just be gigantic.
Big disruption coming, maybe. I don't know. I'm excited about it. I'm looking forward to our chat with it's gonna be actually his name is Paper Bag Investor. That's, I don't know if you guys have heard of him, but he's got his own YouTube channel that he does a lot of lemonade analysis on. We'll be talking with him in a couple nights and post it on our channel. So all right, next question. Let's see here. From Darlin, do you think full self-driving rate will increase again before the release of Cybertruck? Thanks. Cybertruck release is what, later this year, hopefully the first deliveries. I do think that full self-driving rate will increase again before then. I would put the over-under at $15,000 at the time of the Cybertruck reveal. That's my over-under guess, 50-50 probability. What do you think, Matt?
That sounds reasonable. I'd probably take the over on that. You know, if I had to guess, I'd say Cybertruck maybe leaks out to like, you know, Q1 of 23, just because these things tend to not go as planned. But I think, you know, a year from now, basically, I imagine FSD is going to be just drastically better than it is now, and you know, probably will be in wide release in the United States. I would be shocked if it's not in wide release in the United States, and at a much better safety level than it is right now, and with much lower interventions, and like will actually be. I find it not to be like a relaxing use of it right now, but I think 1 year from now it will be a highly valuable thing that drastically improves the overall driving experience, a lot like Navigate on Autopilot does already. So if that's the case, then I think they'll price it more than 15,000. But I don't know. I don't know. If I had to throw a number out in the air, I'd say 18,000, but I could be wrong.
Okay. Someone in the YouTube chat just said insurance companies usually have 100 customers per agent. So Lemonade is literally an order of magnitude more efficient. Wow, that's impressive stat right there to know.
Wow.
Be aware of as well. All right, from Chase Smith, when do you think Wall Street analysis Tesla knowledge will catch up to what you, Dave Lee, Rob Maurer, etc. share? How long will we have the knowledge advantage to Wall Street? I think Wall Street analysis Tesla knowledge may never catch up to the to the top retail investors of Tesla in terms of like, retail investors. We're smart people too. We're not like dumb because we're quote unquote retail. Many of us have very, intelligible careers or jobs, and, investing is a big hobby of ours. We spend a lot of free time, and we spend a lot of time investing investigating our favorite stocks. And there's so much open source information out there now with social media and forums and the internet that we have access to as much information basically than the Wall Street, analysts do. They might have a few extra data points they could access if they want, in terms of like supplier, meetings and such. But I think overall, the retail analysts will know more about Tesla than the Wall Street analysts from this point forward. The Wall Street, unless you have a Wall Street analyst that's like really smart and solely dedicated to Tesla only, not the whole transportation sector, not the whole, full self-driving sector, or whatever the sectors that, most analysts have to cover a group of stocks or an industry, and so for that reason, they can't spend all their time just on Tesla only. That's my thought. What do you think, Matt?
Yeah, if you're covering 20 stocks for Morgan Stanley, you're never going to be as up to date as Rob Maurer, who's literally putting out a podcast of every single day about the developments in the Tesla world. So I think they're better than they were a couple of years ago. Like Alex Potter's consistently been one of the best analysts out there. But I remember looking at his numbers like last year, and I was like, these are ridiculous. Like, he says all the right things, but his numbers still seem like ridiculously sandbagged. So I think there's not a whole lot of incentive for them to go out and actually give Tesla credit for 50% unit growth, or to give them credit for 30% plus, automotive gross margins. So they don't do that. And then they're still coming up with price targets right now of like, $1,000, $1,200. But it's like, if you really dig into those numbers, you say, okay, that doesn't really make a whole lot of sense. So I think they have a hard time just being realistic with Tesla just because it's hard to give them so much credit, and because their time is split with other companies that they're covering.
Yeah. And on top of that, which we talk about a lot, Tesla is really a conglomerate of a lot of businesses. You know, it's not just making cars, not just battery packs, it's not just full self-driving, it's not just now insurance, or it's, you know, it's not just going to be the Tesla bot. It's not going to be neural networks as a service. You know, there's so many massive businesses with it, you know, energy, megapacks, trucks, you know, there's Cybertruck is like its own business almost, you know, so there's so many businesses wrapped into Tesla. It's sort of its own conglomerate. It's so many things now that even like one person can't keep track of all of that themselves if that's all they study. You know, like I feel overwhelmed trying to keep up with all the different aspects of Tesla's business model. You know, like I used to feel overwhelmed, but now I feel really overwhelmed because they've really done so many different things to stay vertically integrated, making their own chips. You know, like my goal is to try to understand, you know, 70-80% of each of these things with only 20 or 30% of the effort needed, you know, versus 100% of the effort to understand 100%, because that's sort of the Pareto principle, right? And so I'm already getting overwhelmed with that. Like there's certain aspects of Tesla's business where I feel like I don't know hardly anything about it. You know, I need to study it more, but then I got to study this other sector of it or this other part of it. So I feel like you almost need a team of analysts with their own unique specialties within Tesla's workings to understand Tesla as a whole. It's like, as you know, that Morgan Stanley has a team of analysts to understand the auto sector and transportation. No, Morgan Stanley should have a team of analysts to understand just Tesla. That's what they need. So in the future, there's going to be some kind of outfit or shop that understands Tesla, hopefully, that has a team of analysts just studying Tesla. And maybe they study competitors of Tesla for each facet that those analysts, but their focus is Tesla. I think that's the best way to get like a good understanding of Tesla. But we'll see if that plays out.
That's kind of like the ARK Invest model, right? Where their verticals are not based on industry; they're based on technology. So, you know, you've got, you know, people who have, you know, chip technology experience that are commenting, you know, both on NVIDIA and on Tesla. So they're able to kind of get specialists on the technology to come together and come up with investment philosophies, you know, jointly. So I think that's a much better model than what most of the Wall Street analysts are doing. But you're right. Like there's so much that needs almost nobody understands Tesla's energy business at all yet. And that's kind of really ramping up right now. So still nobody gives them credit. And that's probably going to be, I don't know, $10 billion next year, somewhere in that neighborhood, I think, just on the megapack side. So I'm very curious to see how that all unfolds. And yeah, it'll be good.
Yeah. From Nick Carter, do you think 4680 structural pack plus giga castings plus exoskeleton equals Cyber Hatch $25,000? That's possible. I mean, I think the Cybertruck is the first stop, and so maybe they'll do other cyber themed vehicles. I know they have the quad, the Cyber Quad, I guess, or ATV or whatever. But yeah, I would not be surprised if they have other cyber themed vehicles in the future after the Cybertruck. I almost think of it as like you have like the utopian vehicles like the Model S and the Model X. They're like so elegant and beautifully designed and luxurious with lots of cool, you know, luxury features. And then you have like the dystopian. So utopian and then you have the dystopian designs coming out now. This like the Cybertruck. It's like ready for Mad Max reality. You know, it's like you know, it's cool. It's hardcore, rugged, and yeah. So there might be more vehicles on that dystopian edge of design coming out in the future. I wouldn't be surprised, and maybe that's like the Cyber Hatch. I don't know, but that would be in the future. But we'll see. By that time, Tesla will be so big, like just an extra vehicle, even if it's, you know, massively successful, is not going to add, you know, it's not going to make Tesla's market cap go from 3 trillion to 6 trillion. It might make it go from 3 trillion to 3.5 trillion or something. It'll still be significant, maybe, if it's a very big success, but you know, each massively new successful model is not going to double the stock price. Like the potential right now for Cybertruck is to have the model, you know, if it becomes and they're producing and selling 500,000 a year or more, like they could, I would see their stock price have 50% upside from where it is now, just on the Cybertruck alone, if it's massively successful. But, you know, in the future, when they have like a new variant or new model, you know, it'll be marginal improvement on the stock upside for each one because they'll already be so big.
Yeah.
From Enter Macbeth on Twitter, on Yahoo, Google, Tesla PE is calculated using GAAP earnings per share. Yet many analysts, including Matt, use non-GAAP. Can you clarify?
If you look at the like forward ratios, that's all the analysts all report on non-GAAP, which is basically just backing out stock-based compensation, and then the other one-time charges. So I believe that's just an incorrect statement there. I mean, I haven't looked at exactly how, like, if you look at their reported PE, like a trailing PE, that it's possible that Yahoo shows that on a GAAP basis, but all the analysts are doing it on a non-GAAP basis. And that's how, Gary Black, that's how all the Tesla Twitter analysts all do it non-GAAP basis. So I think you're probably just mistaken on that, unless there's one area on Yahoo Finance where it shows it otherwise.
Next question. Do you have any hypothesis regarding Rocket Lab Mega Constellation? Will it be before or after Neutron development? That's a good question. I would think if they have some kind of mega constellation, it would be after Neutron development. Like maybe they would announce plans for it, in the next year or two, perhaps. But it wouldn't really be deployed until they had their Neutron up and running. That's my guess. And that's still, I guess, Neutron is still a couple of years out from actually the ETA of it actually making its first kind of launch. What do you think, Matt? Any thoughts on that?
Yeah, I mean, like they need Neutron to lower the cost and to increase the payload size to, vertically integrate so that you can cheaply launch these constellations. I mean, it's kind of what you see with SpaceX. Like if SpaceX tried to launch Starlink before they had Falcon 9, it would just be prohibitively expensive. So I think you have to have Neutron first.
Yeah.
In order to cost effectively, capital efficiently get this constellation up and running. So yeah, I think it has to be that way.
Yeah. Yeah. All right. So last question here. Let's make this the last question, then we'll end it, and maybe we'll get a chance to go to the Twitter Spaces that's still going on. Is Tesla the next Theranos? So it looks like it's still going on. Now has 430 people listening on Twitter Spaces. So I'm going to go over listen to that before the ARK Invest thing starts after this. So our last question here is CPI predictions for ARK for effects on the market. Consumer price index predictions. I don't have a prediction for it. I think every data point seems to be affecting the macro market right now with anticipation of interest rates changing. Hopefully today's testimony by Fed Chairman Powell is kind of stabilizing reducing the uncertainty of how quickly or how far they'll change rates in a given time period for the next 12 months, for example. And so hopefully with the reduced uncertainty in the market, money can be allocated back to the market and stocks can start going up again. That's my hunch, but I don't know for sure. Macro markets are impossible to really, very hard to predict. Matt, you have any last thought on that?
No, I agree with you. I mean, it's very hard to predict. I think we basically gave our perspective on this. I think at the outset of this video, though. I mean, I think the CPI is a concern insofar as it relates to rates, potentially being raised, and I think there's been fairly clear guidance on that, and so I think we're all expecting 3 or 4 rate hikes this year probably, but we don't really have too much cause for concern, I think, unless rates go up like more than 100 basis points, which seems unlikely to me right now, and especially based on Chairman Powell's commentary today that we're going to be in a low interest rate environment for a long time. I think even if we go up 1% from here, that's not going to be the end of the world on growth stocks. So
yeah. Cool. All right, guys. Well, thanks for listening. We're going to shut this down now, and we'll be back next week with another Twitter live stream or YouTube live stream, but also we'll broadcast on Twitter Spaces at the same time again. All right. Thanks.